Hi, everyone. This is Jason Bierk of Wall Street from Main Street. Welcome back for another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He is a managing partner and founder of Oxbow Advisors, over 40 years of experience advising high net worth clients in the investment industry. He's also written 10 investment books. Ted Oakley, thank you for joining me.
You bet, Jason. Glad to talk to you.
And we'll put a link to Ted's new book, which came out, I think, in the last 6 months. But Ted, I want to go back to a conversation we had after the last recorded interview because we didn't get a chance to speak about it on the record here. And you have many decades of experience investing in real estate in Texas. We're recording this interview on Thursday, August 22nd, 2024 for our listeners, by the way. So do you think that Fed rate cuts will help fix, and I'm using air quotes here, a lot of the major problems in U.S. residential and commercial real estate?
I don't initially, Jason. I tell you why. If you look at it, if you look at it, um, and just look at it from this standpoint, let's say prime rate's 8.5, and let's say they lower it a half. Okay, the Fed funds rate, they go from 5.5 to 5. Prime will go to 8%. Maybe you go to a 6.25 long-term rate. But here's the problem: home prices are too high. That's the biggest problem, because if you look at it and then you add in taxes and insurance, I mean, that's one of the bigger problems that you can't get around now. With this asset inflation that the Fed induced, it caused the price of a home to go up so much, something like 475 or 480 average price of a house nationally. Then you can't make the numbers work by first-time home buyers. So I think it'll be a real slow go. While real estate may not fall down, we may spend 4 or 5 years flatline. But I just don't, and I certainly don't think it'll help it in the multifamily area or the commercial real estate area. No, it's just not enough. I mean, these people were borrowing money at floating rate at 3% or 3.25. Now they're at 9. That means the price of the apartments are down, the price of the buildings down, and it's just a mess.
Yeah, we were talking before we started recording, the math is broken. It's just a cash flow problem. So even if the Fed were to start cutting rates, say by 50 basis points, 75, 100 basis points fairly quickly, it wouldn't fix the cash flow problems that a lot of these real estate investors have with the mortgage payments, especially for office space, commercial real estate.
Yeah, and that's the problem. Just think about it like this. Okay, I have a 600 unit apartment complex, and I know there's a lot of these in Texas now are being foreclosed on, or they're really into it with the lenders. And that is, so I got an 80-20 debt to equity type apartment. I started out at the 3% cost. Now I'm paying 9. Okay, so what that does is it lowers the value of the real estate. Instead of having an 80-20, I've got maybe a 95% debt, because my valuation went down. The debt doesn't change. And so all of a sudden the lender shows up and says, okay, you have to put more money in. We don't have any money. My rents are down. So that's happening in a lot of different places right now. And that's the problem with where we are. And if you just lower the rates by half or 3/4, it's not enough to dig these people out. It's just not enough. It's probably not enough if you do 2 points, but it helps. But it's not going to win the war for them, because they started at 3. You remember, they started at 3%, 3.25, floating, and so that's the predicament you're in today.
Well, there's also an oversupply of office space. And you were telling me a couple months ago about the amount of office space oversupply in like San Antonio, Austin, Texas, Dallas, Fort Worth area. You're telling me that the banks, what was it, Capital One Bank? You were telling me the story that Capital One Bank was on the phone trying to offload these things for literally pennies on the dollar.
Oh, they did. I just heard of a major bank in Austin, for example, too. This just happened. They had a 72, I think it was 72 million note on. The people handing the keys back. They ended up, it was going to go into bankruptcy. They bought it back out for like 52 or 54, meaning they lost 18 or 20 million. So maybe the numbers might work now for somebody. But if you look at downtown Austin right now, I know this because I'm looking at a new space. If you add sublease and new lease property downtown, 32% of the market is nobody's in it. So, and then part of that sublease, I understand, but there's still nobody in the sublease either. So the sublease can, they can hurt you on. They're cheaper than a regular lease, especially if you don't have to build out. But yeah, there's all kinds of problems for them, and I think they've got a bit of rose-colored glasses, thinking, oh, it'll work out okay. The Fed's going to come in and go at it again. Well, they may. I mean, if you had bad enough recession, yeah, they may go all the way back down to 3. They could. I don't think it's going to be back down to a quarter of a point again, but I'm not ruling anything out because this is a crazy Fed.
It also looks like the pension funds and the insurance companies, they seem to be in worse shape with the office space exposure than a lot of the banks are right now, because almost every day, Ted, we see headlines where it's a pension fund or an insurance company that's trying to offload some of these office buildings, literally for pennies on the dollar, all cash. They want to get away from the commercial real estate debt, the mortgage debt.
Oh yeah, they just want to walk away. I mean, they know it's in trouble, and the insurers and pension plans are the major lenders into these markets. And one of the problems about the pension funds, not so much the insurance companies, they're pretty savvy, but a lot of the pension funds get their information from their consultants, and I don't think they're getting a good straight shot on really what's going on right now. And one of the problems about pension plans, so many of them and so many foundations, is they probably got a third of their assets, in alternative investments, and they're illiquid. I mean, they don't know what they have really, and they don't know how to get it out either. So that's some of the problems you're going to have with this whole interest rate thing.
Oh yeah, I agree. And a lot of those pension funds prior to the 2000, prior to the pandemic in 2020, they were investing, adding more exposure to what commercial real estate, CalPERS was. They were adding on
Oh yeah.
leverage on the balance sheet. They were adding exposure to
Hmm.
private equity, and they got invested in what these things called private credit pools.
Yeah. Oh yeah. I mean, that's exactly right. That's what's happening here. I mean, you got it. And so it's it. I think people are in denial that it's going to be worse than they. In other words, they think we're going to make it and the credit's coming in, but I don't think that's going to happen. I think they just don't think it's going to happen. We'll see. We'll find out, but I don't think so.
So you brought up something interesting that I actually wanted to bring up, was about the cost of a starter home for the average young adult out there. I think it's more than doubled in price. I think it was around $200,000 in the 1990s or early 2000s, and we're almost around 500,000 average for the average starter home in the United States. Is this even worse in Texas? Because I think I heard that there's an oversupply coming around in the Austin and Dallas Fort Worth area of homes that are close to $1 million. The home builders are building a lot of these, and these things are not selling?
Well, they're having to mark them down. I mean, if you look at, I have a lot of realtors I see, and I just watch their stuff. And when they show you new homes for sale, a lot of times it'll have the price marked out, and they'll drop it, and they'll drop it a little bit. Say it's a $2 million house, they'll drop it to $1,990,000. It's kind of a game, I understand that, but still they're dropping it. And by the time they actually sell it, you don't know what they're going to get for sure, but they're kind of stuck. You see what I'm saying? And so that's what's going on. And the other side is that it's just, we keep building up inventory, and everybody's always like, well, there's not enough inventory. Well, maybe not enough inventory, but nobody's buying anything, so who cares? It
Well,
doesn't make any difference.
a lot of people can't get qualified for a mortgage at $800,000 or more. So I mean, what if you have
Right.
to prove, it's a lot harder to get qualifications for financing for a mortgage
Yeah.
of a starter home, say if it's $800,000 or more.
Yeah. I mean, you can't. I mean, the real estate market is stuck. You've got a group over here that is a real low cost mortgage. They're not going to move, and they're unless they just have to for whatever reason, because their payment is going to go crazy compared to what they have now. So they're not going to move. And then, okay, on top of that, you get in the situation where they go to a new house and then have to put the down on there, and then with a higher rate, again, insurance and taxes, it's high on that high in new house too. And so that's just basically where we are.
So then you don't think that the rate cuts will, it just definitely sounds like it's a lot harder for the average young adult to get a mortgage and pay that down payment without help from family and friends because it's going to be over $100,000 for a lot of these starter homes. And in the past, you could almost get like what 50% down payment that used to be on a starter
Mhm.
home in the past.
Yeah, I mean, no, I don't think initially. Well, you just have to go deeper than people expect to get anything out of it. If you go look at when the Fed starts lowering rates. If they start lowering rates and say a half at a time, or then another half or whatever, they're afraid. Then they know something's wrong in the economy. Well, if that's the case, then asset prices go down. In other words, market goes down, real estate goes down, and that wealth effect that these people have had all along for the last 12 or 14 years, that's pretty much fake, but it's in the marketplace, it goes away, you see. So it causes different kinds of problems, but it certainly causes problems.
Now, you've lived in Texas for a very long time. You were around during the Texas savings and loans problem with commercial real estate and residential in the 1980s. Are
Yeah.
the real estate problems in Texas, are they way worse now than back in the 1980s savings and loans problem?
No, they were worse then. Then we had, what was happening then is the lenders folded up. So what happened is you had a lot of savings and loans, which by the way are a lot like the credit unions today. They were borrowing short but loaning long. And so when inflation came along, when inflation was high and rates were higher, they were having to pay more for money than they had it loaned for. So everybody was upside down, and that just totally imploded the market. And when it did, they all went under, and then it took banks under and different things. But that's why they created the RTC to go out and buy up all this property, which you could buy those properties for nothing. Now, those were some of the best buys in the world. But it was a worse market, Jason, than it is now. I'm not. I don't think this market would get that bad again because I don't think the lenders will go down.
Was there a fire sale on properties back then?
Oh yeah, you could buy apartments, full apartments, for like $10,000 a door or $12,000 a door. I mean, it was crazy. I mean, you could buy an office building that was worth, you know, 10 million for $1 million, that kind of thing. But if you had to have the money though. I mean, people that had money did really well.
Oh, I was going to ask back then in the 1980s savings and loan, you were talking about the deals of 90% discount in some cases. Was that all cash? So you had to have all cash. You couldn't get any debt financing then.
Well, no, you could get some debt financing. They would finance part of it too, but the problem is you had to really be well heeled. You had to be solid, or it wasn't going to happen. That was the point. I mean, things turned, but they didn't turn very fast, and banks were having to take back property. It was a hard time.
So you don't think that'll happen now with office space? Do you think like the banks see that ahead of time and they're trying to what liquidate as many assets as possible before they get stuck with the keys?
You talking about now?
Yeah.
No, I think they don't want it back. Believe me, these insurance companies and the banks don't want anything back. I mean, they'll do anything just about to keep from taking it back. But some of them are having to take it back because there's nowhere else for it to go. It depends on whether it's recourse or non-recourse. And even on non-recourse property, a lot of the lenders now, they've been savvy the last few years, and they have these clauses, and they're like kind of bad boy clauses or things where they could sort of get you on that you didn't run the property right or something. Then they can partial recourse it to you, and that's a problem if you're the borrower. But there's some different things going on now.
Do you think that Texas and Florida have the most oversupply of any of the states and metro areas right now for like overpriced residential homes like that are $800,000 or more?
It depends on where you are. I know, for example, I own homes in different places. But I own a home in Jackson Hole, for instance. That doesn't get affected too much because people that come there all have enough money and think about whatever. Montecito, California, Fort Lauderdale, and different places like that. Aspen, Palm Springs, but other places, yeah, it affects it. If you're just in kind of a sort of a normal town, and the bigger real estate is, it's just moving slower. Effectively, it's what's happening.
Now, in terms of the real economy, do you think that regional banks are starting to have a lot larger losses on like their small business loans, their consumer loans, high interest credit card debt, auto loans? Do you think that the banks are starting to have immense problems?
Well, they're certainly having some problems with on the credit card side because the delinquencies are up to about, they're higher than they have been now in about 5 years or so. Um, but on the major, most community banks are loaned into real estate. That's their primary source of loans. And what's happening with them is it's just started now. You're starting to see people. I know this because I'm on a loan committee at a bank. But what you're starting to see in all the banks, though, is the first inkling of, oh, my cash flow is tight. I need to get an extension on this. I need to work something out. You're starting to get that now, and I don't. You hadn't had it before for a lot of community banks, but now they're starting to see it. So yeah, they're gonna be plagued with it a little bit. Yeah.
And do you think that the Fed rate cuts will help fix this, or do you think that again, this is a cash flow problem that like they're looking at writing off some of these loans, and that the Fed rate cuts won't fix this?
Well, the banks have a dual problem, Jason. The ones that own bonds are underwater on their bonds, and then on the loans, I don't see. It's just not enough. In other words, if you're at an 8.5 prime and somebody's borrowing at 9, then say a half over prime, and let's say you take the rates down to 7.75, well, they're still an 8.25. See, that's not enough help to get the cash flow where you want it to be, and it also values the property lower than it would have been at a 3% rate. And so, that's what you get into, and that's not it's not enough to get what you need to go. That's the 3/4 move. So you can see you need 4 points or something like that before it's all over with 4.5 points to really make it work.
Yeah, I see a lot of problems in the real economy. We're seeing that now with small businesses and a lot of the restaurants that cater to the middle class consumer. They're struggling. They're starting to close down locations, bricks and mortar retail locations. A lot of restaurants are potentially going bankrupt that cater to the middle class.
Yeah. Yeah. I mean, it's been a slow go. I mean, as far as a slow deterioration, but it's there. I mean, it's happening.
And then meanwhile, what the stock market, the S&P 500 had an enormous rally. So it seems like the real economy is just bifurcated, but the middle class is being hollowed out by the policies.
Well, yeah, what middle class is left? I mean, right now you you could call your 200 family making 200 grand. They may not have been considered middle class because of the cost that they have involved in everything: real estate, 2 cars, kids, everything. I mean, it's not like they have tons of money, and the Fed again, the Fed's to blame. The Fed's to blame on all of this. And they keep talking about the Fed, the Fed, the Fed. Fed's the whole problem. They've been the problem. Jerome Powell tomorrow. So what? What's he going to say? I'm going to make everybody happy by lowering a half. I wonder about that because the market fell off today. But people are very, very complacent right now, and they're all in. By the way, we have the highest ownership percentage in the equity markets by individuals that we've ever had. So obviously, they're not afraid of anything, and that's the setup we have.
Yeah, the other problem beside the Federal Reserve Bank and bad policies for decades is the spending coming out of both political parties in Congress, that every time there's a problem, they don't allow bankruptcies and deflation, the market to work itself out. For smart entities there that were disciplined, like your company, to go in and buy assets for pennies on the dollar, they want to try to inflate the stock market again, inflate home prices again. And that seems to have been the policy for the last 15 or 20 years.
Oh, yeah. It's just, I mean, we don't have nobody, nobody, nobody in these parties ever talks about the budget. I mean,
Yeah.
that's not even part of what goes on.
Have you seen the research reports? They're talking about that trillions more of defense investing is needed for Cold War 2.0 just to catch up with China and Russia. They're coming out with these research reports now in the DC metro area.
Oh yeah, I've seen it. I mean, I think they underestimate China, unquestionably. If you look at China's ability to what they have the ability and the time, the speed that they have the ability to make what they make from defense terms, I mean, they run circles around us. But
Well,
they don't have the red tape.
they've also been stealing our intellectual property. I mean, like inside, like with our top secret security clearances, it's for a very long time
Yeah.
too. And they were manufacturing. Our defense companies are still, I think they're still manufacturing a good chunk of the stuff in China, or at least they were.
Oh no. Yeah. There's still. I mean, it's not it's not good right now to underestimate China because of a lot of different things. But I mean, they're a force to be reckoned with, and I think people need to remember that. Not just to say, well, in other words, I don't think their market's going to do good or anything like that, but they're still a force to be reckoned with, and it's just something you just have to remember.
Well, especially because they're the main demand driver for a lot of these commodities, for energy
Yeah,
and industrial metals, for food. So
yeah,
they've been just enormous amounts of demand increases over the last 15, 20, 30 years. And they have contracts now with a lot of emerging market countries for commodity supply. So the US, if they need more commodities, that will be at the back of the line. China will be served first.
yeah. Well, and I think I know my friend. I know you've interviewed my friend Luke Broman before. Luke's a good guy, and he's got as good a take on China, I think, as anybody. But about how that's how that's going to have to work, you know, um, between us and them worldwide, and a lot of different things. But we'll just have to see. I mean, there's a lot of this next 5 years could be really fraught with a lot of things, and I think people need to keep that in mind, or at least have enough money stashed back, conservative money stashed back, so they can get through these things. That's the
Well,
problem we see now is everybody's complacent and they're like, the Fed will take care of us. Well, they may not. So you need to take care of yourself.
yeah, I agree. But I think to your point there, I think US and China relations are deteriorating in my opinion, because if you look at the polling, both political parties, they seem to want to either maintain the tariffs on Chinese goods or increase them. And that seems to be polling very, very well with a lot of American voters.
It probably does, but I'll tell you, Jason, they'll pay the price. Tariffs tariffs have never been good for pricing in the long, long run. And anytime you when you get in this beggar thy neighbor policies like we had pre depression, what happens is it's a vicious circle, and it just doesn't work in the long run. It sounds good politically, but it's not a good thing. You need markets where you can buy the cheapest price at the best price for you. Okay, and if you've got somebody that's a better competitor overseas, and you say, well, since they're a better competitor, we're going to tax them with the tariffs so that they have to match our poorer competitors. See, it's a cop out, and I've never agreed with it, but that's politicians for you.
Oh yeah, I totally agree. You brought up Beggar Thy Neighbor. I mean, that's mercantilism. So that's neo-mercantilism or mercantilism, which is where they raise tariffs on imports to protect domestic industries. So that was what for post-World War II, that was what a lot of manufacturing for aircrafts or auto, a lot of the
Mm-hmm.
key components for electronics and other stuff.
Yeah. So there's just for them to roll out and just say, "Hey, we're going to do tariffs." You're like, well, okay, you know, you might want to think about that a little bit before you jump out and do it. But I mean, again, you just have to wait and see where it is. But that I don't agree with it. They'll probably go ahead and do it anyway. But
Well, I don't think
it's
it's just
something
the
for them to
US.
think.
I think things are headed in the
Oh
wrong
no,
direction. I think the policies, it looks like a lot of stuff is headed towards protectionism and less like just-in-time supply chain global economic trade like that with the just-in-time supply chain, where a lot of the supply chain is made in either Japan, China, and they keep moving the goods back and forth with cheap energy.
Yeah,
That with a lot of companies and countries seem to be going away from those policies now.
yeah, I agree with that. I mean, but the, the point is that if you go the direction of everybody tariff, it puts tariff on everybody else. You just nobody wins in that. Yeah, I'm a big market. I'm a big believer in free markets, but you know, I don't know. We'll just have to see how it goes.
Well, unfortunately, Ted, I think no one learns from history. So I think like a lot of the mistakes, I'm starting to see a lot of similar mistakes in the 1920s and 30s with the economic and monetary policy, and it's repeated again because what Kamala Harris was talking about going after those evil grocery store owners and their profit margins are not high at all.
Oh no, I mean, well, first of all, it sounds good because it's a vote getter, but what happened the last time they decided to put in wage and price controls was Richard Nixon, and that's when they had the win buttons that everybody would wear, whip inflation. Now it was a joke. Everybody front ran it because they knew they rigged it such that there was a certain amount that going to go up per year. So they had all kinds of systems to rig through it, and actually inflation got worse after that. And it was just a joke because once you cap something, then you pick up all sorts of black markets and a lot of different things come out of that. But wage and price controls won't work. They'll
Oh,
work,
yeah.
they a little bit of time, but then in the long run, they never work.
Well, they potential shortages too. Potential shortages for
I
sure.
mean,
Look at the grocery store shelves in Venezuela when they started to put in wage and price controls.
and there's a lot of reasons on agriculture. I mean, if you look at it, it depends on the weather that year. There's so many things, but if you, I'm not certain quite what they're looking at because if you look at soft commodities, I'm talking about corn, soybeans, all sorts of things. Anything that goes into food like that, it's going down in price, right? Really way down though. Wheat, what I mean, they really corrected. So um, if there's any, and it's if there's anywhere to be had, it's not at the grocery store level or at the lower level to the farmers, the makers. It's going to be the middle. That's where that's where they stack it. So you have to realize who you're going to go after. And a lot of those people that she wants to go after probably are donating to her. She might want to be careful with it. I don't personally carry the way, but I'm just saying it's interesting to watch.
Well, they're trying to buy votes. That's what it seems to me. What because they did the student loan debt bailouts too. The Biden administration did at least 150 billion in student loan debt bailouts to try to buy votes in the past congressional election and then for the this upcoming presidential election too.
No question about it. I mean, it's an election year. No telling what's going to happen. And then the first year of a new term, regardless of who it is usually not very good for the market. So we'll see where it heads, I guess.
Well, actually, I was going to ask you about that about past election cycles. And then when the Fed does start to cut rates, what normally happens to the stock market since you've been through different cycles?
Well, I can give you a lot of examples on that, but I'll just give you the last three or so. And if you looked at 2000, 2008, 9, and in 2020 with COVID, those markets broke and they broke hard. I mean, and so, broke hard and they broke fast. And what happened, I don't think people realize the reason the Fed is lowering rates is because they see that things are falling apart. You see, but yet people think, well, they'll lower rates and we'll go back like we were before. Well, that's not the way the game works because this machine is too big. It's like a big freighter. You can't turn it around. I mean, it takes a long time, and they get completely confused on this thing. And it's so interesting to watch them trade the market. And when they lower the rates, it may rally for a couple of days, but it won't rally long. And then you'll take it down, and then you go from there. So uh,
Do you also think that the Fed keeping rates this high, not starting the cuts, and the relative strength of the dollar in the global economy, has that started to really hurt a lot of these foreign banks? And that's what we're seeing play out with the yen carry trade unwind and some of these other things.
well, I think the carry trade was getting. I think it was damn. damaging the yen so much that, or the spread was getting damaged so much that they came in and said, "Hey, look, hey, we're not going to do that for a while." But what I think's happy is all of these countries are going to be in a recession, if most of them are now, and it'll be one of those things where everybody would like to have their currency be the best. Where they could buy more of your goods than you could buy theirs. That sort of thing. Mine will go further, but that's where you get into these wars again, like you had back in the Beggar Thy Neighbor days, where everybody was trying to get the jump on everybody else, and in the end, it just implodes. Is what really happens, and I suspect long run, long run, I suspect the dollar will go down, especially when they start lowering rates. It will go down.
So it sounds like you're expecting then with Beggar Thy Neighbor, this is what Jim Rickards wrote about in his 2011 book, Currency Wars. And then that's part, trying to manipulate your currency for a favorable exchange rate. That's that leads to trade wars, protectionism, and tariffs. You think that similar cycle could be repeating similar to the 1920s and 30s right now?
I do. It could. And I'll tell you why. There's a great little book out there. I probably read it 6 times, and I have it. But John Kenneth Galbraith wrote a little book. It's small. You can read it in an hour and a half. Called The Crash of 1929, and it's not just about 1929. It starts picking it up in the late night, like 1918, 1919. Shows you everything going on up until that time. And if you didn't know the names of the players, or the name, if you kind of pull the names off and put back in today's names of people and players and things, you would have a lot of similarities today, because people don't realize real estate went way up before the markets peaked in those 20s, but then it rolled over, and Florida started getting weak. Different things started happening, but it rolled over first, and then the markets imploded. You had way too much leverage, just like you have now, too much leverage, and then the whole thing came down, and everybody, they were so used to it going up that they were so close-minded to this. After the first break, which was the 29 break, they thought, oh, it's over now, so we can buy everything and it's going to be great. Well, they realized by 32, it was 29, by 1932, you were down 90% almost. And so, it just got worse and worse and worse, and there was no way to turn it around. And I think that's what people need to understand, is you need a certain amount of your money that is so bulletproof that you're not going to have to worry. I always think about this. Think about whatever the worst thing you think could happen, to sort of double it, and so, because you never know what will happen. And just make sure that you have some sort of safety valve. And I see so many people today, especially people 75, 80 years old, no safety valve. They got almost everything in the market. I'm like, it's just an accident waiting to happen.
Oh yeah, I've just heard horror stories of people that are retirement age that are liquidating a lot of their other stocks, and went, instead of any type of diversification or focusing on like dividend growth or anything like that, they wanted to put a large chunk of it into Nvidia or Bitcoin or
Oh yeah.
artificial intelligence stocks lately.
Yep. Oh yeah. I see it. I see it. I see it all the time. And they're not going to listen to anybody. But I saw this, and honestly, I saw it 99, 2002, and I saw people lose a lot of money. I saw people in 2008 lose 100% of everything in their portfolio. I'm talking about 10, 15, 20 million portfolios. They lost everything.
Well, my
Went to
grandmother
zero.
didn't have a financial education, and she barely graduated high school, and she inherited a nice nest egg from my grandfather when he passed away. And when she passed away in like 2008, we saw that her stockbroker had sold her like over $500,000 in mortgage-backed securities and real estate investment trusts that were down over 90%.
Oh yeah. Yeah, and what you'll see about, if you read this little bit about the crash, because it's exactly what happened, is that it's sort of like today, everybody was complacent. So in the first, when they started breaking, before you got to the big break, before it started, people would be like, oh, it's going to be everything. Really, the markets are okay, and the government would say that, and they were there to save the people, and then nothing worked. Then it all imploded together. So, yeah, I mean, that's where we are today. I mean, I wish we could tell you it was different, but it's not.
Well, we're seeing a lot of increased amount of volatility in stocks and bonds because the VIX was really quiet for a very, very long time. And then in the last couple of weeks, we just saw an explosion in the VIX. It looked like the margin calls from the yen carry trade carried over into the leverage short volatility trade.
Yeah. Well, I think that's true, and you're starting to see this when you see high volatility, real high, like that's usually at the tops and the bottoms of markets. You get to a real low in the market, and it gets the same way. You have these big moves back and forth, but that's telling you you're getting there. Same way with a high, and then when you get into a day like today, I'll give this an example when they're selling everything, including the gold miners, and almost everything, all the tech, gold miners, most everything except some of the energy they didn't sell, but everything else got sold. And so you have to remember that kind of how this goes. But when people get scared, and I think this is one of the problems with insurance companies and pension plans, they have all this illiquid money. So when they get scared with the other assets going down, and by the way, that private money is not worth that much either at that time, but they don't know this. So they'll go sell what's liquid, which is their stocks, you know, because they can't get money out of the alternatives. You have to look at all the ramifications of how this setup is. But there again, they've been sold. All of that's been sold to them by consultants, and you know, a consultant's just a consultant. What can I say?
Well, those are high commission salespeople. Yeah, they're not being objective and trying to make sure that they're diversified. They're selling whatever's the highest commission for themselves or whatever will get themselves as salesmen the largest commissions and profits for annual salary. And that's why private equity was so popular with the pension funds, because they were so susceptible prior to the 2020 pandemic at buying into private equity and commercial real estate. And so, then you had firms like SoftBank and others that were buying those unprofitable Silicon Valley tech company shares.
Yeah, we're not going to really know how this market is until we spend some time going down. Let's say you go down 20% or 25% or 30%, and it lasts a while, and you take people out. But I think the Fed looks at they they should be looking at the economy. The stock market would be reflecting the economy, but I honestly think the Fed looks at it like the stock market. The economy reflects the stock market, because you look at them, they'll come running every time the market goes down. So we'll see, but that's kind of where it is.
Well, you also have a big divergence between the larger indexes, which are market cap weighted, dependent on what the big tech companies, NVIDIA and the Mag 7, so the S&P 500, the NASDAQ 100 versus the small cap, the Russell 2000, and what 30 or 40%, only about 30%, I think, of the small caps in the Russell 2000 even have profits. So that index with the small caps is not doing well.
Oh no. Well, they ran in to buy them, and I knew that was a mistake here a few weeks ago, a month ago or something. I'm thinking, hey, this is not where you buy the small caps. But they keep trying to find a place, and it's once you get at the top of the market, it gets very, very hard to hide, and that's really the bottom line. It gets very hard to hide.
So I want to ask you about playing defense in this type of macro environment where there's a lot of cross currents, and we see what the major stock market index is up, but it seems that the real economy, the consumer, and many different data points we could talk about with the earnings calls from a lot of companies appears tapped out. Do you think it's smart to start diversifying and playing into what more defensive plays like cash, treasury bills, gold, dividend stocks, consumer stable dividend stocks, and energy plays?
Well, we started that. We started that a couple of years ago for us. I mean, we own. If you look at our three strategies, and they just average out the number of treasuries we have in all three strategies, it's about 50% treasuries. And we're getting a good yield on them, and they're real short term. But we just, we look for certain things in those strategies we want to buy, and the prices are just too high now. They're just too high, and what the problem with that is that you end up with a situation where people look at it and say, well, you're not keeping up with the S&P. And I'll be frank with you. We don't want to keep up with the S&P because there's 40% of the S&P is in 10 stocks and they're all overpriced. And so, see, all that's coming together. And so when they start selling in unison, and that hasn't happened yet, but once they start selling in unison, they're only going to sell the big names because they make up the ETFs and the indexes. So if that's what you're invested in, that you're going to get hit. Now we own a little bit of those, but not much. I mean, we own a lot of different things, but you just have to be careful.
Yeah, Stanley Druckenmiller, I think he's always ahead of the curve. I mean, he's been cashing out of his NVIDIA. I think he was in NVIDIA in late 2021. He started to get into NVIDIA and artificial intelligence stocks. He was ahead of the herd back then. So, and now he's been taking profits for months now on those.
Well, I'm sure, I know his record well. I'm sure whatever he's doing, he's doing it well because he's had a great track record.
Well, I tend to look at, some of the best investors in the world because they've been through different cycles like you and how they're reacting to this. And when you look at what interest rates where they are, the consumer tapped out, it's looking like it's smarter to play some defense. And you're starting to see the big name investors. I think Warren Buffett, the only thing he's been buying lately are some of the energy plays like Occidental Petroleum. He's bought a lot of a lot of long-term U.S. Treasuries. I think lately he might own more than the Federal Reserve Bank. And Stanley Druckenmiller has been buying gold miners.
Well, we have a big position. We have the largest position we ever had right now in two of our strategies in gold, and then we own the gold miners in two of the strategies as well. So yeah, we like gold and we like the miners. I mean, that's really sort of they've been the cheapest thing. They've had the best return this year about anything, but also they they're in a position where if what we think is going to happen the next 5 to 10 years, then gold will do it should do well, and I always give this, I've written it before, but people don't realize on gold, it depends on whether you do the miners or the bullion. If you're going to own the bullion, you need to just own it and not trade it. Now the miners you need to trade. There's times when you buy them, they're cheap now, or they get not as cheap as they were, but they're cheaper still, and then they just really take off and go well above where the bullion is. And everybody comes into them, and then you sell them, and you don't keep those. Keep the bullion though, because that's really what you want to own for the long term. I'm talking about 20, 30, 40, 50 years. And I can give you a lot of reasons for that, but I think people they'll say, well, I don't get any cash flow or anything like that, but they forget about whatever gold would buy in 2000 and what that same amount of gold, what would it buy today? If they'll do that equation, they'll come up and say, "Oh, I see why you own it now."
Well, you've also said that you're a big proponent of the royalty companies, that you've invested in Franco-Nevada for a very long time. And I mean, those companies at their earnings power, those businesses at 2,500 gold or gold a little bit below 2,500, they're going to have enormous profit margins and free cash flow. And you don't have to worry about the cost increases of the regular gold miners.
No, that's what we like about them. And we own two. Well, we've owned Franco. Don't own as much of it now. They've had a little trouble with the mine down south, but we own a lot of Royal Gold, which are also overrides. We don't own Wheaton, but that's one you could own. I mean, they're fine group too. But yeah, it's just we do the same thing with oil and natural gas as well. We love to have the royalty piece. That's where we think you ought to be.
So for the oil and natural gas royalties, the property has to be drilled, right? So they don't, it's not the same type of profit margins and free cash flow as a gold and silver royalty company. It's a little bit, the business model is a little different for oil and natural gas.
No, it's basically the same. You have to, when you have royalty on a gold mine, you're going to have to go mine it and get it out. And same way, if I have a lease that covers, let's say, 10,000 acres, and let's say I have a quarter royalty, a quarter mineral interest, then the people that have the lease are going to want to keep on drilling too because they make more money. Well, when they make more money, I make more off the royalty, and so it's similar to have to keep mining the gold to get the gold. It's a similar thing. You have to keep turning. You just have to make sure in the leases you have that you have plenty of room to drill. In other words, you don't want to buy a property, take the override on a property where there's no more spacing left. I mean, you can't do anything.
Okay, I see. So they're similar enough. I mean, Franco-Nevada, I think they're 10% of their annual revenues are in oil and natural gas royalties, and they were buying a lot of $150 million worth of natural gas royalties in the Haynesville Shale around the liquefied natural gas export facility in Louisiana recently.
Well, that's where you should be. I mean, one of our private deals we did last year with a really good group, and this is where we like to do this kind of thing. Is that we did a private placement on, and it's nothing but natural gas royalties. It's in the best parts of the Haynesville, very best, and it's going to work out great. But we love the overrides. We think that's where you should be.
And it also says that part of your investments in defensive are into pipeline companies and oil producers that are doing acquisitions, trying to buy assets at a reasonable valuation, like ConocoPhillips. So I think those on a valuation standpoint, energy, a lot of the old school energy plays are out of favor and the valuations are cheap. And I think there's good long-term growth there too.
Well, they certainly underestimate. I mean, everybody's overestimating the ability of electric vehicles to be able to do what they need to do because there's just not enough juice to make it go. So oil and energy, natural gas, are being underestimated because there's so many places in the world that you can't get electricity to. You have to do fossil fuels, and we'll see how it goes. But I think that they thought it would be real easy, but it's not going to be as easy as they thought.
Yeah, I agree. The other major issue is in a lot of these other countries that that have a lot of electric vehicles, they have oil and natural gas drilling bans domestically, and I think the politicians and the people that are doing the energy policy in those countries, they're like, "Oh, we'll just import liquefied natural gas. We'll just build a liquefied natural gas import terminal for tens of billions of dollars." They don't have any domestic supply, so then I guess then the U.S. is going to fill in that gap with liquefied natural gas exports.
Yeah, I mean that's what they think, and it's again. This takes 5 to 10 years. I think it's going to be a real sobering time for people just to be realistic about things. I mean, if I showed you the amount of net electricity, especially with AI and the data ports and all this sort of thing that's needed the next 5 to 10 years, and what we have, which is maxed out, by the way, that's why we own a few utilities. We haven't owned utilities in 15 years, maybe 20, but we bought utilities this past year, and they've done well. But one of the reasons is because they have to price up because their electricity's tight right now, and so that's one of the things. That's just one of the things you get into.
I think Warren Buffett also has put out in his Berkshire Hathaway at the conferences and his investor newsletters that the utilities, this is the most growth that the American utility companies have for electricity demand growth in decades.
Oh, no question about it. And see, we're not producing, but the problem, that's why your grids are tight because you're not producing, you're just not producing enough. And, we're far behind on nuclear, and China's off, they're going to run circles around us on nuclear too. So,
Didn't
that's just
Texas have power
where we are.
outages right there? There were shortages for electricity, shockingly, in some areas of Houston and other areas of Texas,
Oh, yeah.
uh, even though you guys have some of the cheapest natural gas in the world.
Well, the problem is the grid. And if you talk to, and ERCOT does as good as they can, but they have a problem matching things up. So if it gets really hot or really cold, it becomes a problem, you know. And so that's what's happened. But again, you're going to have to get more going. That's what you're going to have to do.
Or the electricity
Yeah.
has to be able to easily be able to move from one part of the state or one state to another easily, and we just don't have the
Yeah.
grid for that either.
No, we don't have. And so, all of those are the similar problem. You just have to work on them, take care on them, but that's where we are.
Well, Ted, I want to thank you so much for your time today. Please tell my listeners more about your new book.
Well, I haven't finished it. I'm working on a book entitled, it's basically, I don't have the exact title, but it's on the second, third generation wealth, and how, as a first generation wealth person, matriarch or patriarch, how are you going to transfer that wealth so that you don't desecrate the lives of those young people. And you want those young people to come out with great self-esteem, the ability to stand on their own 2 feet. But if you have a lot of money, you can slip up on that, and it doesn't work well. Some of them do really well. It's a very, very hard subject to write about, I might add, because there's all sorts of things that go into it. But I know some really good people who do it well, and I know some people that do it poorly. And it has, a lot of it has to do with the kid. Like different things. There's some do's and don'ts on it that we're going to try to publish, that we're pretty certain that these do's and don'ts are pretty good. I mean, they'll tell you where you need to be. But yeah, I mean, we'll see. I've been working on this book for a while because it's hard to think. You can think about it's harder to write because there's no holy grail or no certain way you have to do things, because every family and every kid's a little different,
Well,
for
also
sure.
you also have the social media pressures now with the younger adults. I think it's all about like the trust fund babies now. There even is a hit song now that they're playing in the nightclubs about like a 6'5" and then a trust fund for finance bro and a trust fund. So like
Yeah.
it's all about what fear of missing out, FOMO, and then YOLO, you only live once. So that's being expedited, and the trust fund baby that is dating like Instagram models and spending all their money, that's looked at as good. But someone who builds a business or works really hard, delayed gratification, that's looked at as, oh, you're boring, oh, you're not having fun.
Yeah. No, that's true. Again, a lot of lessons to be learned here, I think, the next 5 years, but we'll see. I mean, we may be totally wrong on it. If it is, we'll make an adjustment, but that's certainly the way we see it.
Well, I want to thank you so much for your time today. You also have their YouTube channel where you're interviewing similar guests to me over there, and you have your new books, and I'll attach links to those for my listeners.
Okay. I appreciate you doing that, Judge. Good to talk to you again.